Welcome back to Yahoo Finance Live. We are seeing a bounce in markets today, but not making up for yesterday's losses. Jared Blikre is with us now from the floor of the New York Stock Exchange. What's going on, Jared?
Well, is this the start of a bear market rally? Because yes, you've been keeping track of a lot of things here, and I gave you are doing Yo People's work when it comes to describing the events over the last 24 hours, and Brian Chung in particular really breaking down the credibility issue of the Fed. And just reading through the Bank of America Global Fund Manager Survey, I do want to pick out one thing here. When it comes down to contrarian trades, and this has to do with how much the Fed is going to raise rates and what that means to the market. If the Fed goes 50 beeps in June, that means they're behind the curve. And the survey says that they will have to position deeper for risk off via short oil and resources. So that's kind of a contrarian trade. Also short big tech. If the Fed goes 100 basis points, that means they're ahead of the curve. Position risk on via short US dollar, long EM, that's emerging markets, and low quality growth stocks. And so maybe we're in the middle right now. I think the calculus is if the Fed takes a pain, if the Fed makes the economy take the pain now, that means the eventual path of interest rates, the destination of the short-term rates is going to be a little bit lower than it would be if the Fed just takes a lackadaisical approach to fighting inflation. So that's my read on the matter. I think they go 75 beeps, might see a little relief rally tomorrow, but just remember the last time is 6 weeks ago we had a similar situation. The Fed, Powell said some nice words to the market and we had a nice update, 2 or 3%, and the next day it was reversed. So just keep in mind, bear market rallies are often flashy, but oftentimes short-lived. I want to show you guys what's happening in the bond market, because this is really raising some eyebrows on the Wi-Fi Interactive here. Here's the Bank of America Move Index, and this tracks bond market volatility just like the VIX, and you can see big spike up yesterday. You take a look at what's going on with the 5-year, the 10-year. It doesn't quite look like this move in rates is done, and until it is, it's going to cause more pain for equities, guys.